What if I told you, most people in the US aren't broke because they don't earn enough, they're broke because their time runs out every single week. You can grind overtime, pick up side hustles, even get that promotion, but there are still only 24 hours in a day. The real flex, the wealthy don't sell their hours anymore. Their money works for them 24/7, even while they sleep. In this video we're breaking down what passive income actually means in 2026 America, the 4 easiest, beginner-safe ways to start building it, realistic starting amounts, the traps that wipe out 90% of new investors. If you're done trading your life for a paycheck, stick around. This is your 2026 Glow Up Blueprint. Let's go new. Passive income is one of the most misunderstood ideas in personal finance. A lot of people think passive income means getting paid forever. That's not true. Passive income doesn't mean zero effort. It means you put in effort or capital up front, and that effort continues to pay you for months or even years with very little daily involvement. Think of it as front-loaded work. At the beginning, you either invest time, money, or both. You research, you set things up, you make decisions, but once the system is built, the income keeps flowing without you needing to show up every day. That's the difference. In the United States today, passive income mainly comes from 3 major buckets. The first bucket is investments. This includes stocks, index funds, ETFs, and bonds. When you invest in these, you're not working for income, your capital is. Companies use your money to grow, and in return, they share profits with you through dividends or interest. The second bucket is income, producing assets. Real estate is the classic example. But passive income real estate doesn't mean fixing toilets or answering tenant calls at midnight. In the US, many investors use REITs or professionally managed properties, where the asset produces income while someone else handles the work. The third bucket is automated systems. These include digital products, licensing, or content royalties. You create something once, and it keeps earning. While this video focuses on investing, the principle is the same. Build once, earn repeatedly. Now let's compare passive income with active income. Active income is simple. You trade your time for money. You work an hour. You get paid once. If you stop working, the income stops. Passive income flips that model. With passive income, your capital trades time. You invest once. Time does the heavy lifting, and you get paid again and again. Here are real-world passive income examples Americans are using right now in 2026. You receive quarterly dividend payments from EF that hold hundreds of companies. You earn monthly income from REITs that own apartments, warehouses, and offices across the country. You collect interest from US government bonds, one of the safest income sources available. And in some cases, people still earn royalties from content or products they created years ago. Notice something important here. None of this requires daily effort. None of it depends on your mood, your health, or your boss. And none of it stops just because you take a day off. That's the real power of passive income. The bottom line is simple. You move from a life where you work for money to a system where your money works for you. And that shift from me working to my capital working is how long turned in America. Let's be honest about the reality of the US economy in 2026. On paper, things may look stable. But on the ground, most Americans feel constant financial pressure. Prices are higher than they used to be, and they're not coming back down in any meaningful way. Groceries cost more. Rent is higher. Insurance premiums keep rising. Even basic monthly expenses take a bigger percentage of income than they did just a few years ago. Inflation doesn't need to be extreme to do damage. Slow, steady inflation quietly eats purchasing power year after year. If your income stays flat while prices rise, you are effectively moving backward, even if your paycheck looks the same. Now add job insecurity. Layoffs are no longer rare events. They happen in technology, finance, retail, healthcare, media, every major sector. It doesn't matter how skilled you are or how hard you work. One earnings call, one cost-cutting decision, or one economic slowdown can remove your primary income overnight. That's the problem with relying on only one paycheck. Then there's healthcare. In the United States, a medical issue is not just a health problem, it's a financial risk. Even with insurance, deductibles, co-pays, and uncovered treatments can create some expenses that derail years of savings. One unexpected bill can undo months of progress. And when it comes to retirement, the truth is uncomfortable. Social Security was never designed to replace your full income. It helps, but it does not support a modern lifestyle. Company pensions are mostly gone. For the majority of Americans, retirement planning is completely self-funded. If you don't build your own income streams, there is no backup system waiting for you. This is why passive income is no longer optional. Passive income is not about luxury or showing off. It's about resilience. It acts like a financial airbag. When layoffs happen, income doesn't drop to zero. When medical expenses show up, you're not forced into debt. When you're tired or burned out, you have options. Over time, passive income allows you to build wealth, not fast money, but durable wealth that compounds over 10, 15, or 20 years. It shortens the distance between where you are and financial independence. It gives you control over how much you work, not because you're lazy, but because you value your time. And maybe the most underrated benefit is peace of mind. When markets are volatile or the economy slows down, people with passive income sleep better. They don't panic at headlines. They don't live paycheck to paycheck. They make decisions from a place of stability, not fear. In 2026 America, passive income isn't about getting rich. It's about staying financially sane in a system that rewards preparation and punishes dependence on a single source of income. For most Americans starting their passive income journey, dividend investing is the gateway, and in 2026, it's still one of the strongest foundations you can build on. The concept is simple. You buy shares in profitable, established companies. Those companies generate cash. And instead of keeping all the profit, they pay a portion of it back to you, usually every quarter, just for being a shareholder. You don't need to sell anything. You don't need to time the market. You just hold, and you get paid. That's why dividend investing works so well for beginners. It's tangible. You see real money hit your account. That psychological feedback keeps people invested long-term. Now, not all dividends are created equal. In 2026 that continue to hold up best are utilities, electricity, water, energy, infrastructure. Consumer staples, food, household products, essentials people buy in any economy. Healthcare, pharmaceuticals, medical devices, insurance. These businesses don't depend on trends or hype. People still need power, food, and healthcare during recessions. That stability is exactly what you want when building passive income. Let's talk realistic numbers, not fantasy yields. In today's market, high-quality dividend ETFs typically yield around 3–5%. Individual dividend stocks can yield 4% to 6%, but they require deeper research and carry more risk. Here's a simple example. You invest $10,000 into a strong dividend ETF with 3% yield, something similar to what SCHD has historically offered. That investment sends you roughly $380 per year in cash, paid automatically. No work required. Is 380 life-changing? No. But here's what beginners often miss: reinvestment. When you reinvest those dividends, you're buying more shares. Those shares pay dividends too. Over time, compounding quietly accelerates the income. What starts as hundreds per year can turn into thousands without you adding more effort. This is how long-term passive income is actually built in America. Now, an important beginner rule: skip individual stock picking at the start. Most new investors underestimate how much research it takes to analyze dividend safety, payout ratios, balance sheets, and long-term business risk. One bad pick can wipe out years of income. Instead, go straight to dividend ETFs. They give you instant diversification, professional screening, lower risk, less emotional decision-making. Two popular examples: Americans UCHD Schwab US Dividend Equity ETF. This focuses on high-quality companies with strong cash flow and a history of growing dividends. It balances income with long-term growth. VYM, Vanguard High Dividend Yield ETF. This offers broad exposure, low fees, and steady income across many sectors. With dividend ETFs, the strategy is boring, and that's a good thing. You invest consistently. You reinvest the income. You ignore the noise, set it, forget it, and over time, watch those dividend checks slowly turn into a reliable passive income stream. Looking for the simplest and most reliable path to long-term wealth in America? This is it. Broad market ETFs and index funds are not exciting. They don't promise overnight riches, and that's exactly why they work. These funds invest in hundreds or even thousands of companies at once. Instead of trying to guess which stock will win, you own the entire market or a large piece of it. The most common options Americans use are SP 500 ETFs, which track the 500 largest US companies. Total market ETFs, which include large, mid, and small companies. Dividend, tilted index funds, which add a small income component. This approach removes one of the biggest risks in investing, being wrong about a single company. One major reason these funds are perfect for beginners in 26 is diversification. When you own hundreds of businesses across technology, healthcare, finance, consumer goods, and energy, no single failure can destroy your portfolio. Some companies struggle, others grow, and the market adjusts automatically. Another advantage is cost. Broad ETFs come with extremely low fees, often between 3% and around 6% per year. That means almost all of your money stays invested and compounding for you. Over decades, low fees make a massive difference, often more than trying to chase higher returns. Historically, broad US market funds have done something very important. They outpace inflation. While prices rise over time, these funds benefit from economic growth, innovation, and productivity. On top of that, they also pay modest dividends, which can be reinvested to accelerate compounding. There's a reason most 401 and II millionaires are built this way. Not through day trading, not through market timing, but through consistency. You don't need to predict crashes or booms. You don't need to watch financial news every day. You simply invest regularly, whether the market is up or down. Even 50-year to 200 per month matters. When you invest monthly, reinvest dividends, and give the market time to work, you allow compounding to do what it does best. Small, boring contributions quietly grow into meaningful wealth. Millions of Americans didn't become wealthy by being smart every day. They became wealthy by being patient and letting broad market ETFs do the heavy lifting for them. For a long time, Americans believed real estate investing meant only one thing: a huge down payment, a 30-year mortgage, and dealing with tenants, repairs, and late-night phone calls. That model still exists, but in 2026, it's no longer the only option. Today, beginners can invest in real estate without owning a single physical property. The most popular entry point is REITs, or real estate investment trusts. A REIT is a company that owns income-producing real estate. This can include apartment buildings, shopping centers, office spaces, warehouses, data centers, and even healthcare facilities. When you buy a REIT, you're buying a small piece of all those properties. Here's the key benefit: REITs are required by law to pay out most of their income to investors. That income comes directly from rent. For you, that means real cash payments, often every quarter, and in some cases monthly. You don't manage tenants. You don't fix anything. You don't answer phone calls. You just collect income. What makes REITs especially beginner-friendly in 2026 is the low barrier to entry. You can start with 100 to 500. They're just like buying a stock or ETF. This allows everyday Americans to get real estate exposure without taking on massive debt. A popular example is VNQ, the Vanguard Real Estate ETF. It provides broad exposure across many real estate sectors and has historically offered yields around 3.9% to 4%, depending on market conditions. Another option is real estate crowdfunding platforms. These allow investors to pool money to invest in specific projects, like apartment complexes or commercial properties, with relatively small minimum investments. While these can offer higher yields, they may come with less liquidity and more risk, so beginners should approach them carefully. And if you're ready later, traditional rental property is still an option. Using a mortgage allows you to leverage your investment, controlling a large asset with a smaller amount of capital. This can accelerate wealth building, but it also increases responsibility and risk. It's best treated as a later stage move, not a starting point. One important reason REITs are gaining attention again in 2026 is interest rates. As rates trend downward, borrowing becomes cheaper. Cheaper financing helps real estate companies expand, refinance, and improve cash flow, which often supports higher property values and stronger dividends. That's why many investors see REITs as a smart, low-stress way to add real estate income to a diversified passive income portfolio without the headaches. Are rarely exciting, and that's exactly why they matter. In a world where markets move fast and headlines create panic, bonds play a very specific role in a smart investment portfolio. They don't exist to make you rich overnight. They exist to protect what you've already built. For beginners in 2026, bonds and fixed income investments are about stability. The most common options Americans use are U.S. Treasury bonds and bond ETFs. These are backed by the U.S. government, making them one of the safest income sources available. They pay regular interest and hold their value much better than stocks during market downturns. Another popular option is Bonds. Bonds are designed to protect your money from inflation. Their interest rate adjusts with inflation, which is why many investors are paying attention to them. As of 2026, bonds are offering yields around 4%, making them attractive for conservative income and purchasing power protection. Short-term treasuries and short-duration bond funds are also popular. They're less sensitive to interest rate changes, which makes them more predictable and less volatile than long-term bonds. So why include bonds at all? First, they stay stable when stocks crash. When markets jock sharply, bonds often hold their value, or even rise. That balance can prevent panic selling. Second, they provide predictable income. Interest payments arrive on schedule, which helps with cash flow and planning. Third, they reduce overall portfolio risk. Bonds act as shock absorbers, smoothing out volatility and making your investment journey less stressful. Bonds won't double your money. They won't go viral on social media. But they do something far more important. They protect your capital so you can stay invested, stay calm and sleep at night while long-term strategy keeps working. Most people don't fail at investing because they're unlucky. They fail because they repeat the same mistakes over and over. The first mistake is chasing guaranteed high yields. Any investment promising 10–15% returns with no risk is usually a scam, junk product, or ticking time bomb. In 2026, these offers still exist, they just look more polished. Real investing rewards patience, not desperation. The second mistake is unrealistic expectations. Turning $5,000 into $5,000 per month in 6 months isn't investing, it's gambling. Passive income takes time. Years, not weeks. Wealth is built slowly, then suddenly, but only if you stay consistent. The third mistake is never reinvesting dividends. Cash payments feel good, but compounding is where the real magic happens. Reinvested dividends buy more shares, which generate more income, which accelerates growth. Skipping reinvestment kills momentum. The fourth mistake is waiting for the perfect moment. No one consistently times the market. History proves that time in the market beats time in the market. Every year you wait is a year compounding can never recover. Avoid these mistakes, and you're already ahead of most investors. Building passive income doesn't require complexity. It requires structure and consistency. Here's a simple, realistic roadmap that works for everyday Americans. Step 1. Open a brokerage account. Platforms like Fidelity, Schwab, and Vanguard are reliable, low cost, and beginner-friendly. Opening an account is free and takes less than an hour. This is your foundation. Everything else builds on this step. Step 2. Start small and focused. You don't need 10 investments. You need 1 or 2 solid ones. A common beginner combination in 2026 is a dividend ETF for income and a broad market ETF for growth. For example, SCHD for steady dividends, VTI or VO for long-term market growth. Optionally VNQ if you want real estate exposure. This gives you income, growth, and diversification without complexity. Step 3. Automate your investing. Set up automatic monthly investments. Even $100 per month matters. Automation removes emotion, timing mistakes, and excuses. You invest whether the market is up or down. Step 4. Turn on dividend reinvestment. This is critical. Reinvested dividends buy more shares, which generate more income over time. This is how compounding quietly accelerates your progress. Step 5. Stop watching the noise. Financial headlines are designed to trigger emotion. You don't need daily updates. Checking your portfolio once a quarter is enough. Investing works best when it's boring. Step 6. Stay consistent for 5 to 10 years or more. Time is the most powerful ingredient. The longer you stay invested, the more compounding works in your favor. Wealth in America isn't built through viral trends or hot tips. It's built through boring, disciplined consistency, repeated month after month, year after year. Passive income isn't about getting rich quick. It's about getting free. Free from trading every hour of your life for money. You don't need to be rich to start. You start to become rich, if this hit home. Smash that like button. Subscribe to bell for weekly real talk finance. Talk pass tutor 6 in the comments. I'll reply with my current beginner starter pack. Your money deserves to hustle as hard as you do. Start today. I'll see you in the next one. Peace.